Hey, welcome! So forget about trying to time the market, and definitely forget chasing the next hot stock. Today, we are going to talk about building a financial fortress, what I like to call a forever portfolio. It's not designed for a quick flip, but for a lifetime of steady, predictable income. We're going to shift our entire focus from the sale price to the paycheck.
So here's how we're going to break it all down. First up, we'll tackle the one choice that really defines your entire journey as an investor. Then we're going to steal a page right out of Warren Buffett's playbook. After that, we'll get our hands dirty and analyze a real-world company. Then we'll get into a really powerful technique to supercharge your returns. And finally, we'll bring it all together into one single lifelong strategy.
Okay, before you even think about buying a single share of stock, we have to talk about the most important question in all of investing. And it's not what you should buy, it's why you're investing in the first place. Seriously, your answer to this one question is going to shape every single decision you make from this point forward.
So, let's just get right to it. What's your goal? Are you trying to plant a tiny seedling and hope it grows into a massive tree that you can one day chop down and sell for a big lump sum of cash? Or are you trying to grow a tree that just keeps dropping fruit into your basket, season after season, year after year? That's really the core difference between investing for growth and investing for cash flow.
And this slide lays out those two paths just perfectly. The growth approach, over on the left, is all about reinvesting. A company like Apple takes its profits and pours them back into the business, hoping to expand and make its stock price soar. Your wealth grows on paper, which is great, but you don't actually see any of that cash until you sell. Now, the cash flow path on the right is totally different. Here you own a company like Procter & Gamble, a classic what they call a dividend aristocrat, which takes its profits and sends a piece of it directly to you, in your pocket, as a dividend. It's an immediate, tangible return just for being an owner of the business.
All right, to really get this cash flow mindset, we need to learn from the master himself. So let's dive into the Warren Buffett playbook and see how he thinks, not as a stock picker, but as a business owner. You know, this quote, this gets to the absolute heart of the Buffett philosophy. It's a massive shift in thinking. You're not a trader trying to flip a stock for a quick buck. No, you are a business owner, and you are acquiring a piece of a durable, valuable asset that you plan on holding, ideally, forever.
So why is this forever mindset so incredibly powerful? Well, it comes down to two really simple reasons. First, a great business is like a cash machine that just keeps running, constantly generating earnings that either grow its own value or get paid out directly to you. Second, and this is a huge one, it's unbelievably tax efficient. Every single time you sell a stock, you gotta pay taxes. By holding on, you let your money compound and grow without that constant tax drag, year after year after year.
So how do you find these forever companies? Well, Buffett gives us this brilliant, simple starting point, a single number. He looks for a debt-to-equity ratio that's below 0.50. All this really means is that the company isn't drowning in debt. For every dollar of its own money, it owes less than 50 cents to somebody else. It's a super simple but powerful test for financial stability.
In this visual shows us exactly why that number matters so much. Think about it. When the economic seas get rough, a company that's loaded up with debt is like a ship that starts taking on water. Those debt payments have to be made no matter what. And you know what's the first thing they throw overboard to stay afloat? Your dividend. But the low-debt company, it can weather the storm, continuing to send you those dividend checks like clockwork. That right there is the power of stability.
Okay, enough theory. Let's get practical. How do we actually find one of these cash-producing machines and, kick the tires? We're going to walk through a step-by-step analysis using a company everyone knows and loves, Disney, to see if it really has the DNA of a company you could hold forever. We're just going to follow this super straightforward three-step process. First, we apply the Buffett rule. Check the debt. Is it below that 0.50 magic number? Second, we look at the company's real net worth, its book value, to see if it's growing consistently. And third, we check the engine of the entire operation, its earnings. Now, before we look at any data, let's get this definition crystal clear. Book value is not the stock price. The stock price can go wild based on emotions and speculation. Book value is the real, tangible net worth of the business. What would be left if you sold off all its assets and paid off all its debts? It's the underlying equity that you, as a part owner, are actually entitled to.
This table, wow, it tells such a powerful story over a decade. Just look at the book value column. It's a steady, predictable climb upward. This isn't hype, this is the company's real worth growing, year after year.
Now look at the debt column. See how they started a little high, above our target? But then watch how they systematically, purposefully brought it down below our 0.50 goal. That is the signature of a disciplined, really well-managed business.
And this chart is exactly what we want to see. We are not looking for those chaotic, up and down, squiggly lines of a stock price chart. No, we're looking for this, a smooth, predictable upward slope in the company's actual worth. This is the kind of foundation you can actually build a portfolio on.
So it's really vital to understand where this value actually comes from. It all starts with the company's earnings. And those earnings, they can only go to two places. They can either be reinvested back into the business, which grows its book value, or they can be paid out directly to you as a cash dividend. That's it. It's that simple. And that simple flow is the engine that drives this entire strategy.
All right, we've found our solid cash-producing company. That's our foundation. Now, let's talk about how to build a cash flow skyscraper right on top of it with a strategy that's called the wealth wheel.
Okay, I know this sounds complex, but just stay with me, because the idea is actually incredibly simple. Let's say you want to buy Disney, but you'd really prefer to get it at a bit of a discount. By selling a put option, you are basically telling the market, hey, I promise I will buy 100 shares of Disney if the price drops to this specific level, my strike price, by a certain date. And just for making that promise, another investor pays you cash, called a premium, right now. Today, deposited into your account, you literally get paid to set a buy order for a stock you already want, at a price you get to choose. It's amazing.
Now, let's flip the coin. Let's say you now own those Disney shares and you're collecting those nice dividends. Well, you can generate another stream of income by selling what's called a covered call. This is just a promise to sell your shares if the price rises to a level that you choose. And in exchange for making that promise, you get paid another cash premium right now. It's like getting paid to set your own sell price.
And this is how it all fits together into this beautiful system, the wealth wheel. Step 1, you get paid to wait to buy the stock you already want. Step 2, if you end up buying it, you get paid to own it through dividends. Step 3, while you own it, you get paid even more by selling those calls. And step 4, if your shares get sold for a profit, you collect that profit and go right back to step 1. It becomes a perpetual cash flow machine.
The key thing to understand here is the trade-off. A traditional growth stock, it's like a rocket ship. The upside is theoretically unlimited, but it could also just fizzle out on the launch pad. The wealth wheel, on the other hand, turns your investment into something more like an apartment building. You might not double your money overnight, but you're collecting rent from multiple tenants, month after month, consistently. You're basically trading that lottery ticket upside for reliable, predictable cash flow.
So, let's tie all of this together now, because these aren't just a handful of tactics or tricks. No, this is a complete philosophy for building a financial engine that can literally power your life.
These are the core beliefs. First, you've got to shift your focus from the sale price to the paycheck. Second, buy those stable, low-debt dividend kings that you'd be happy to own for the rest of your life. Third, use a system to generate income at every single stage of the process. Fourth, always remember this is a marathon, not a sprint. And finally, use this as your guiding principle for every decision. Will this purchase increase my cash flow next month?
And so I'll leave you with one final question to just kind of ponder. Take a look at everything you own. Are your assets paying you, or are you paying for them? Thinking about that could really change your entire financial future. Thanks for joining us.